Physical silver is tightening at 67, and if that sounds like just another price headline, then you're missing the most important part of what's unfolding right now, because this is not about futures charts, it's not about paper contracts, and it's not about speculative momentum. This is about real metal, real inventory, and real supply stress showing up where it matters most, at the dealer level in wholesale markets and across physical distribution channels that normally operate quietly in the background. And when those channels start to show strain, it tells us that something fundamental has shifted beneath the surface of the silver market. Right now, dealers are not reacting to hype, they are reacting to availability. And availability is becoming harder to secure at current prices. Not because demand suddenly exploded overnight, but because the system that feeds physical silver into the market has been running tight for a long time and is now being tested at higher price levels. To understand why this moment matters, we need to separate two very different silver markets that most people mistakenly treat as one, the paper market and the physical market, because they operate on entirely different dynamics. And today those dynamics are diverging in a way that deserves serious attention. Paper silver can be created, traded, and settled without a single ounce changing hands. It is liquid, flexible, and responsive to macro headlines. But physical silver is constrained by mining output, refining capacity, transportation, fabrication, and inventory management. And when physical silver tightens, it doesn't do so dramatically. It does so quietly through longer delivery times, reduced availability, rising premiums, and dealers struggling to restock inventory at predictable prices. That is exactly what we're seeing now. At $67, the price itself is not the shock. The shock is that physical supply is not flowing smoothly at that level, which tells us the market is discovering that the assumed availability of silver at scale may no longer match reality. For years, the silver market operated under a comfortable assumption that above-ground inventories were sufficient, that recycling would respond if prices rose, and that industrial demand could be managed without disruption. But those assumptions were built during a period of slower industrial growth, lower energy intensity, and looser monetary conditions. And the world has changed significantly since then. Industrial demand for silver has become more rigid, more strategic, and less price-sensitive, particularly in areas like solar energy, electronics, medical equipment, and advanced manufacturing, where silver's properties are difficult to replace without sacrificing performance or reliability. At the same time, mining supply has not kept pace, not because companies lack interest, but because the economics of silver production have become more challenging, or grades have declined, permitting has slowed, and capital investment has lagged during years when silver prices were suppressed relative to costs. This has created a slow, persistent supply imbalance that did not cause headlines when prices were lower, but becomes impossible to ignore when prices rise and physical demand remains firm. Dealers sit at the front line of this imbalance. They are the first to feel it when supply becomes inconsistent, when wholesalers ration shipments, and when premiums begin to rise independently of spot prices. When dealers struggle to source supply at $60 it means that the physical market is no longer passively absorbing price increases. It is pushing back, signaling that price discovery is still underway. This is an important distinction because in a healthy, well-supplied market, higher prices tend to unlock supply and reduce demand. But in the current silver market, higher prices are not immediately solving the problem. They are revealing it. Dealers are not panicking, but they are adjusting, reducing exposure, extending delivery timelines, and becoming more selective about inventory commitments, all of which point to tightening conditions beneath the surface. This matters because the physical market ultimately anchors the entire silver ecosystem. Paper prices can move quickly, but if physical availability does not follow, premiums widen, arbitrage breaks down, and confidence in paper pricing weakens. We have seen versions of this dynamic before, but rarely at this scale and under these macro conditions. What makes this moment different is the broader economic backdrop. Global markets are repricing risk, capital costs are higher than they were during the last decade, and supply chains are under pressure from energy costs, geopolitical friction, and policy-driven industrial expansion. Silver sits at the intersection of all of these forces. It is both a monetary metal and a critical industrial input, which means it absorbs stress from multiple directions simultaneously. When investors reassess inflation risk, silver benefits. When industries expand capacity, silver demand increases. When supply struggles to respond, physical availability tightens. All three of these forces are active right now, and they are converging at a price level that the market is still adjusting to. That is why 67 matters not as a ceiling, but as a stress point where assumptions are being tested. Another crucial aspect of this tightening is inventory behavior. Physical silver inventories are not transparent in the way oil or grain inventories are. Much of the metal sits in private vaults, industrial stockpiles, or is embedded in finished products. This opacity allows supply tightness to build gradually without obvious warning signs until suddenly delivery delays and sourcing issues emerge. When dealers report difficulty sourcing metal, it often reflects a broader reluctance among holders to part with inventory at current prices, either because they expect higher prices or because they need the metal for their own operations. This is a subtle but powerful shift. When physical holders become less willing to sell, price elasticity decreases and the market becomes more sensitive to incremental demand. That sensitivity can persist even if prices consolidate because the underlying behavior has changed. It's also important to understand that physical silver does not respond instantly to price signals. Unlike financial assets where capital can move in seconds, physical supply requires time, logistics, and coordination. Refiners cannot instantly increase output, miners cannot rapidly expand production, and fabricators cannot quickly alter material requirements. This creates a lag between price movements and physical adjustments. And during that lag, tightness can intensify. Dealers experiencing sourcing challenges at $67 are effectively telling us that this lag is becoming visible. This is not a breakdown, but it is a warning that the system is operating closer to its limits than it has in the past. For long-term observers, this is the kind of signal that matters far more than short-term price volatility. It suggests that the silver market is transitioning from an environment of surplus perception to one of scarcity awareness. Scarcity awareness does not require absolute shortages. It only requires enough friction to change behavior, and behavior is clearly changing. Dealers are adapting. Buyers are adjusting expectations, and the market is learning what prices are required to balance real supply and demand. This learning process is what price discovery looks like in the physical world, and it rarely happens smoothly. There may be periods of consolidation, pullbacks, or increased volatility, but the underlying message remains the same. Physical silver availability is no longer taken for granted. That realization has implications beyond the dealer level. Industrial users who rely on consistent silver supply are paying attention. They do not want to be exposed to future disruptions, so they begin to secure contracts, diversify sourcing, and hold more inventory when possible. This behavior reduces the amount of metal circulating freely in the market, further tightening conditions. At the same time, investors who prefer physical exposure over paper instruments are reassessing availability and premiums, which can reinforce demand even if spot prices fluctuate. These feedback loops are not speculative. They are practical responses to uncertainty, and once they take hold, they tend to persist. This is why the phrase "dealers struggle to source supply" should not be dismissed as anecdotal. Dealers operate on thin margins and high turnover. If sourcing were easy, they would not hesitate. Their caution reflects real constraints. As we move through this period of market repricing, the physical silver market is acting as a signal, not a headline generator. It is quietly telling us that the old assumptions about abundance may no longer apply at scale, and that prices are still in the process of adjusting to a new reality. In the next part, we'll examine how this physical tightening connects to broader macro forces, why higher prices alone may not immediately solve supply constraints, and what signals to watch as the market continues to adapt. Because understanding these dynamics is essential for anyone trying to make sense of where silver goes from here. What makes the current tightening in physical silver especially important is that it is unfolding alongside a broader shift in how global markets are assessing risk, liquidity, and reliability. And this context matters because physical silver shortages rarely emerge in isolation. They emerge when multiple systems apply pressure at the same time. One of those pressures comes from the industrial side, where silver is no longer treated as a marginal input, but as a strategic material that underpins entire production chains. Solar manufacturers, for example, cannot simply pause demand because prices rise. They are locked into long-term capacity expansions, driven by policy targets, energy transition mandates, and capital already committed to factories and infrastructure. When these industries encounter tight physical supply, they do not retreat. They secure contracts earlier, hold inventory longer, and absorb higher costs, all of which reduce the amount of silver available to the open market. This behavior does not show up immediately in spot prices, but it shows up very clearly at the dealer level, where restocking becomes slower and less predictable. At the same time, the financial environment has changed in ways that amplify these effects. For much of the last decade, low interest rates and abundant liquidity allowed markets to treat supply disruptions as temporary and easily managed. Today, capital is more selective, financing costs are higher, and inventories are no longer cheap to hold. This changes how both producers and intermediaries behave. Mining companies are cautious about overexpanding because capital expenditures are more expensive and regulatory uncertainty remains high. Refiners and fabricators are careful about inventory because holding costs have risen. Dealers are more exposed to volatility because replenishment cannot be guaranteed at predictable prices. All of these factors converge to create a tighter physical market, even if demand growth appears gradual rather than explosive. Another important element is the role of hedging and forward contracts. In a stable market, hedging smooths supply and demand, allowing participants to manage price risk without stressing physical availability. But when prices move rapidly and availability tightens, hedging becomes more complex. Producers may be reluctant to lock in future deliveries if they are uncertain about their ability to source metal, while buyers may push to secure physical supply rather than rely on paper exposure. The shift away from purely financial hedging toward physical security can exacerbate tightness, especially in a market as relatively small as silver. The result is a feedback loop, where perceived scarcity encourages behavior that reduces circulating supply, reinforcing the original signal. This is not panic. It is rational behavior under uncertainty. It is also why physical market stress often appears before broader recognition sets in. Another layer to consider is the global nature of silver flows. Silver does not remain confined to one region. It moves through international supply chains, and disruptions or policy shifts in one part of the world can affect availability elsewhere. As countries reassess resource security and supply chain resilience, strategic stockpiling becomes more common. Even modest increases in strategic holdings can have an outsized impact on a market with limited elasticity. When silver is diverted into longer-term holdings, whether by industrial users or sovereign entities, it effectively exits the active market, tightening conditions for everyone else. This dynamic is difficult to quantify, but critical to understand because it explains why availability can deteriorate even when headline production numbers appear stable. Production figures tell only part of the story. Allocation behavior tells the rest. It's also worth noting that physical silver markets are deeply interconnected with investor psychology, but not in the way most people assume. Physical buyers tend to be more patient and less reactive than paper traders. They are often motivated by long-term considerations rather than short-term price movements. When physical buyers encounter tight supply, they do not rush to sell into strength. They tend to hold or accumulate strategically. This contrasts with paper markets, where positions can be rapidly adjusted. The divergence between these two behaviors can create tension, especially when prices rise. But physical availability does not improve. Dealers caught in the middle feel this tension first. They see orders come in, inventory move out, and replenishment lag behind, which forces them to adjust pricing, premiums, and customer expectations. This adjustment process is what we are observing now. It is also why dealer commentary is such a valuable signal. Dealers are not trying to predict the market. They are trying to manage inventory risk. When they struggle to source supply, it reflects real constraints, not sentiment. Another aspect that deserves attention is the role of recycling. Recycling is often cited as a pressure valve for silver supply, but its capacity is limited by collection rates, processing infrastructure, and economic incentives. Much of the silver used in industrial applications is dispersed in small quantities across millions of devices, making recovery difficult and costly. Even when prices rise, recycling cannot instantly fill the gap left by primary supply deficits. This reality means that recycling contributes to supply over time, but cannot respond quickly enough to relieve short-term tightness. Markets that rely on recycling to balance demand often underestimate this lag, and when that lag becomes apparent, repricing follows. This is another reason why physical silver tightness at current prices is meaningful. It suggests that traditional balancing mechanisms are insufficient under current conditions. We also need to consider how expectations shape behavior going forward. When market participants believe that physical silver will remain tight, they act in ways that make it so. Buyers secure supply earlier. Sellers delay sales, and intermediaries reduce exposure. This self-reinforcing dynamic does not require dramatic events. It unfolds gradually through countless small decisions. Over time, these decisions reshape the market structure. Silver's current situation reflects years of such decisions coming to fruition. The price level of $67 is not the cause of the tightening. It is the level at which tightening becomes visible. That distinction is critical. It means that even if prices fluctuate, the underlying dynamics may persist. Understanding this helps explain why physical market stress often lingers even after price corrections. The market has already adjusted behavior, and behavior does not revert as quickly as prices. For viewers trying to assess what this means for the future, the key is not to focus on extreme scenarios, but to recognize incremental change. Physical silver markets do not collapse overnight, but they do evolve. Tightness leads to higher premiums, longer delivery times, and greater segmentation between wholesale and retail markets. It can also lead to increased interest in substitutes or efficiency improvements, but these responses take time. In the interim, the market operates under tighter conditions, and prices reflect that reality. This environment rewards understanding rather than speculation. It favors those who pay attention to physical signals over paper noise. It also underscores the importance of distinguishing between price moves driven by sentiment and those driven by supply dynamics. The current situation clearly belongs to the latter category. As this process continues, we should expect ongoing adjustments rather than a single dramatic resolution. Markets will test assumptions, participants will adapt, and new equilibria will emerge. The role of physical silver in this process cannot be overstated. It is the anchor that ultimately grounds pricing and reality. When that anchor tightens, the entire system feels it, even if the effects are uneven and delayed. This is why dealer struggles to source supply are not a footnote. They are a central piece of the story. They tell us that the silver market is not simply reacting to price. It is responding to constraints that price alone cannot immediately resolve. As we look ahead, the most important signals to watch will come from physical flows, not headlines. Availability, premiums, delivery times, and allocation behavior will continue to reveal how the market is adjusting. Those signals matter far more than day-to-day price movements because they reflect the underlying health of the system. And right now, those signals are telling us that physical silver is operating under tighter conditions than many had assumed, a reality that has implications for pricing, risk management, and long-term market structure.